So we quickly first recap what we, sorry, we quickly recap what we saw in a last class. Okay. So local currency is basically the currency in which we prepare the standalone financial. For standalone alone financial. Financial. Functional currency is basically currency which you use for our business. Okay, maximum. Okay, so maximum means say for if we took a loan, okay, like say for the 5 million, and my total turnover is approximately 2 million. Okay, so if I took a loan in a euro and turnover of subsidiary in maybe in INR, okay, as we use the 5 million euro more, okay, so euro is my functional currency. Okay, then the reporting currency is basically in which currency we are consolidating the financials. Used for consolidation. So it is generally the local currency of the parent company. Okay, so these three currencies which you need to keep in mind: local, functional, and reporting. Okay, so when we transfer the financials from local to functional, okay, so then what we do here? Remeasurement. Okay, and when we transfer from functional to reporting, so it is basically the translation. Okay, so if the functional and the reporting currency is same, functional and the reporting currency is same, like we can see here. So reporting currency and functional currency is the same. Okay, so then you need to do the remeasurement. Okay, because what you are doing, we are converting the financial in a functional currency, but the functional currency is equal to the reporting currency. So there is no need for further translation. Okay, so you can use the financials which we prepare in a functional currency. Okay, and if we do the local to means yeah, functional to, and then okay, okay, means the local currency itself is my functional currency. Okay, so in that situation you need to do direct translation. Okay, so means local to functional and then translation. reporting. Okay, so here we need to do the remeasurement or temporal method. That also you need to keep in mind. Method. And here we need to do the translation. Okay. If the local and functional currency is the same, then you need to do only translation method. Okay. Because this is automatic done. So there is no remeasurement. Okay. And if the functional currency and reporting currency is the same, then you need to do the remeasurement. Translation is not required because this is the same. Are you okay with me? Okay, so local to functional, we need to do the remeasurement. Functional to reporting, we need to do the translation. If local currency and functional currency is same, then you just need to do the translation. If functional currency and reporting currency is same, then you need to do the remeasurement. Okay, so that you need to keep in mind. Clear? So remeasurement is also the temporal method. Remeasurement. Okay, so it is again means temporal method. That also in MCQs they may ask convert or any question, and they may say as per the temporal method. So you need to know means we need to do the remeasurement. Okay, so how we can convert? Okay, remeasurement when we are using local to functional. Okay, so at that time we need to do the remeasurement. Okay, and functional to reporting we need to do the translation. So that is separate part. Okay, so how we can change? Okay, means how we can remeasure. So for balance sheet item, there is a certain monetary and non-monetary. Okay, so monetary item, monetary means the debtors, mostly the current asset excluding inventory, and non-monetary is fixed asset and the inventory. Okay, so for monetary, we need to use the current spot exchange rate or the current exchange rate, and for non-monetary, it is historical. Okay, so that you need to keep in mind. Okay, then for income statement, this is for balance sheet. Income statement, like all non-balance sheet item. Non-balance sheet item means the second effect not goes to the balance sheet. Okay, so say for cost of goods sold. Okay, so these are basically the second effect goes to the inventory. Okay, depreciation, amortization. So second effect goes to the balance sheet side. Okay, so that's why non-balance sheet item we need to use the weighted average. Okay, and for balance sheet item, mostly only three items like cost of goods sold, then depreciation and amortization. So the rate which we are using for here, so it is historically non-monetary item. Okay, so that we need to use. Okay, because we are using the different rate. If you see the P&L item or the balance sheet, we are using the different rate. Okay, in balance sheet we are using the current exchange rate as well as the historical rate. Means we apply some item current exchange rate and we apply historical rate to the some item. Okay, so there is some differences arises in the balance sheet, and the same in P&L as well. So weighted average for some some item we apply the weighted average, and for some item we apply the historical. So there is a difference in balance sheet as well. Okay, so how we need to recognize. Okay, so in income statement plus currency gain loss to get the income to required amount needed to adjust retained earning in order to make the balance sheet. Okay, so whatever may be the difference, I mean in a balance sheet, the exact difference which we need to carry it from profit and loss account, Okay, and that we need to adjust in a current income or income statement, I can say. Okay, so it is basically the balancing number which we need to give a effect to the PNL. Okay, so this way we need to do. Once I'll explain when we do the detail example, but just keep in mind whatever may be the remeasurement gain and loss in income statement, that we need to recognize as a currency gain and loss to get the net income required amount needed to adjust the retained earning in order to make the balance sheet balance. Okay, so like whatever may be the differences arises after conversion. Okay, so that we need to maintain in a currency gain and loss. Okay, so in remeasurement, whatever may be the currency gain and loss, that we need to rotate through the income statement. Okay, in translation we need to rotate in a other comprehensive income, that we will see. Okay, so that you need to understand first. Okay, so why the currency gain and loss arises? Because when you are converting the INR balance sheet to any foreign currency balance sheet, you are not using the single rate. Okay, sometimes you use the weighted average, sometimes you are using the closing rate, and sometimes you are using the historical rate. So that's why there is a certain differences arises. Okay, so if that, and that difference we need to rotate through income statement. Okay, then translation method. So if the financial statement of a foreign subsidiary are the subsidiary's functional currency, the financial statement are translated to the reporting currency. Okay, starting from the income statement. So that is basically like functional to reporting. Okay, so here we need to do the translation. Okay, or the second name is like for remeasurement, second name is temporal method. Here it is current rate method. So as we saw, if the local and functional currency is same, then you need to do the translation. You do not require to do the remeasurement. Okay. So foreign currency equals to functional. Foreign currency means whatever I am saying, the local currency. Okay. So income statement, all income statement at weighted average rate. So whatever may be the related to the non-monetary item. Okay. So that also we need to use the weighted average rate. So single rate in a PNL. In PNL. Okay. Which is weighted average. Okay, so there is no need for any difference recognized in a PNL or income statement. Income statement. Okay, so that you need to keep in mind. In like temporal method or remeasurement, okay, for PNL item we are using the two rates. One is weighted average rate and one is historical rate. Historical rate we are generally used for the depreciation, amortization and cost of goods sold. Okay, so that is the difference. And because of that reason, at two places there is a we need to recognize the currency gain and loss. One is in a PNL and one is in a balance sheet. Whatever I talk right now, that is for the temporal method, not for the translation method. Okay, for the remeasurement. Okay, not for the translation. In translation method, we are using the single rate in a PNL. So there is no question of any difference. So whatever may be the net income, that you need to transfer to the retained earning. Okay, for balance sheet, now you need to see balance sheet, asset, okay, year end or the current rate. Current rate. Okay, liability same. So asset means total asset. Again the same. But common stock or the additional paid in capital like equity section, that is at historical rate. Okay, so whatever may be the difference, that is basically the retained earning that absorb in a retained earning. There is no difference carried forward from the income statement. Okay, so this is basically the roll forward. Okay, and whatever this difference arises, that we route it through other comprehensive income. Okay, so translated retained earning is equal to the beginning translated retained earning plus translated net income for the current period less translated dividend declared for the current year. Okay, so translation gain or loss means because we are using the historical rate for the common stock and additional paid in capital. Okay, so that's why there is a difference arises. That translation adjustment is routed through other comprehensive income. So the translation adjustment is equal to difference between the debit and credit of the translated trial balance. And why it is arises? Because common stock additional paid in capital we are converting with the help of historical rate, not current year end rate. Okay, so that you need to understand. Okay, so translation is quite easy. Then remeasurement. In remeasurement you need to first evaluate monetary item, non-monetary item. In income statement you are going to use the two rates, one is weighted average and the second is historical. Okay, in balance sheet you are using again two rate, like closing or the current rate and the historical rate. Okay, we need to recognize the differences at two level. One is in income statement, because in income statement also we are using the two rates, and one is in the balance sheet, that we are doing in a remeasurement or the temporal method. In the translation method or the current rate method, we are using the single rate for an income statement, so there is no difference arises in an income statement. In a balance sheet, we are mostly using the current year-end rate. Okay, only for the equity section, we are using the historical rate. And retained earning is basically the roll forward. So it is basically the opening retained earning, translated opening retained earning, whatever the net income we need to add. And if there is a dividend, so that also we need to translate it, declared dividend for the current period, that we need to reduce. Okay, and whatever may be the closing balance arises, that is retained, that we need to keep as a retained earning. And whatever the differences arises balance sheet, and the difference arises in a balance sheet because we recognize the common stock with a historical rate, that we need to recognize as a translation gain and loss. Okay, and which we need to rotate through other comprehensive income in a comprehensive income statement. Clear? So you can see translation income statement single rate at weighted average, balance sheet at year end rate, stock and epic at historical rate. Stock and epic means common stock, not the inventory stock. Okay, and the roll forward retained earning. Whatever may be the difference, that is accumulated other comprehensive income, because we need to rotate through gain and loss in other comprehensive income. So we need to make an adjustment in accumulated other comprehensive income. In the remeasurement, we need to, for balance sheet, we need to use the two rates, monetary year end rate and the non-monetary at historical rate. So non-monetary mostly the fixed asset as well as the inventory. And the income statement, we need to recognize the some item at most of the item at weighted average. Only the cost of goods sold, depreciation and amortization we need to recognize with the historical rate. And gain and loss to net income is an amount necessary for retained earning plug. Okay, so whatever may be the difference in retained earning, that we need to consider as a gain and loss on net income. So we will see this example. These are the different rates. So the parent company organized the subsidiary on December 31st, year 1. Okay, so exchange rate they gave December year 1 to March 31st, year 2, it is 0.18, April to June, June to September, and October to December. And so they calculate the weighted averages 1275. Inventory was acquired evenly throughout the year, and sales were made evenly throughout the year. Okay, so that's why you can use the weighted average also, means historical rate, so that you can use from here. Okay, so first 3 month 0.18, April to 30th June 0.13. So you need to calculate, because when you are using the historical rate, whatever the rate applicable on the date of inventory, that we need to consider. Okay, so if you buy the inventory in January, February and March, so you need to apply for 3 month 0.18, then April, May, June for 3 month 13, July to September 0.10, and October to December 0.10. So that we need to consider. I hope you are able to understand. Okay, and then they gave the balance sheet. So we will see one by one how we are going to consider the rate. Okay. So here, see, we saw this one. If you see from here, so 0.18 is my closing rate. Okay. You need to calculate with this historical rate. Historical. Okay. And this is your weighted average. So it is given actually. Okay. So closing you can consider 0.18 because this is applicable. Sorry, not this one. 0.10 is the historical in year 2. It is applicable as on 31st December. So this is basically the closing. Not this one. This is opening actually. Okay. Historical you need to calculate one by one with the help of this rate, and the weighted average is 0.1275. It is given. Now we go one by one. Okay. Inventory we need to calculate historical rate. So that's why um, like we need to apply means we need to calculate for every 3 months like this. Okay, so we need to take an average of all this rate. Okay, and the fixed asset we acquired on a subsidiary by the subsidiary on December 31st year 1 on this date, so we need to consider the historical rate of 0.18. Okay, for fixed asset. Now we see one by one. Okay, for sales the weighted average exchange rate. Okay, no, we need to think for remeasurement. Okay, so that you need to consider remeasurement we are discussing. Okay, in remeasurement all PNL item except the non-monetary item we need to use the weighted average. Weighted average is given 0.1275. Okay, we need to use the historical rate for historical rate for three item: depreciation, amortization, and cost of goods sold. Okay, so here the cost of goods sold we took a weighted average because inventory is basically evenly distributed, and all 4 quarter weighted average is also 0.1275. Means if you see, okay, so here 1275 how we calculated. Like for first 3 months, it is 0.18, 0.18. Then again 0.13 for a second 3 month, and then zero point 0.1 plus zero point 0.1. So if you see this, it is 0.51, and then if we do the divide by 4, so it is basically again 0.1275. So it is more or less equal to the weighted average. Okay, and as we saw, I mean we need to distribute the inventory evenly, so that's why we need to calculate the weighted average. Okay, so this basically for this one. Okay, cost of goods sold. Cost of goods sold, we need to calculate the historical rate, means we need to calculate the weighted average. As the weighted average and the historical rate are more or less same, So that's why we are not able to see the difference. Okay. And then depreciation expenses 0.18 because we took the asset on a 31st December on that day. It is 0.18. And then again, this is weighted average, weighted average, weighted average. Okay. Okay, that we will see. Okay, so because this one and the cost of goods sold, this one, there is a different exchange rate. Okay, so that's why the currency gain arises. Okay, so total cost and expenses we need to calculate like this, and the net income also we need to convert with a like exchange rate. Okay, so that's why the plug two means the currency gain is arises.
So from where they have received the values, they have assumed
Which
values.
value means these are the values? No, no, it is given in the
Yeah,
local currency 525,000, 4,000, 400,000, 22,000, 31,000. These are the local currency values. And we are
where they have mentioned in the question, sir.
in the questions, you will not get this kind of question. This is for understanding. Maybe you can get the question in a simulation. Okay, mostly you need to get a question that data like the depreciation is this expenses in a local currency, and you need to calculate what could be the I mean the currency how much what amount you need to consider for the as per the remeasurement method. So you need to keep in mind in remeasurement for depreciation we are using the historical rate, not an weighted average rate. So you will get this kind of question. In simulation, you may get entire local currency financials, and in a question they gave, I mean, like this, they gave the weighted average, closing currency, and the periodic currency. Accordingly, you need to calculate.
Okay.
Okay. So, net income you will get as per the retain earning. In retain, means how we calculate the retain earning, that also you need to understand. Okay, this is statement of net income 42,000. Okay, so that when we converted this 42,000, we will get the 11053. Okay, and the same amount we are getting here. Okay, see, in a like remeasurement method, first you need to you cannot match the financials basically. Means this number is you cannot calculate immediately. Okay, this number. Okay, what you need to do, you need to convert everything, and then you need to convert the balance sheet. Okay, so you will get the closing retain earning number, this one, this one. Okay, that would be your retain earning. Okay, so this may be the first year of the financials, so that's why there is no accumulated balance or something like that. Okay, and if this is the first year, so retain earning 11053 is basically the income carried forward from the PNL. So here I want to see the same income I need to maintain. Okay, and because of that reason, okay, so and this difference I need to calculate. Means what I did first, I need to calculate the balance sheet difference. In a balance sheet, the exchange rate we will discuss that also. The first we need to calculate the balance sheet difference. So I come to know what would be the income carried amount carried forward from the income statement. Once I get that amount, that I need to keep as a net income, and then I need to calculate the difference. Okay, so it is basically like the revenue minus expenses minus income, or revenue plus income minus expenses. So whatever may be the difference arises, that I need to consider here. Clear? Sorry, the formula is basically, I mean,
So
revenue.
why they have kept in the negative 6,854?
Okay, we will see revenue minus expenses total. Okay, minus net income. Okay, this will be basically my currency gain loss. Gain loss. Okay, so what is my revenue? 66,9318. Sorry, 66,938. Total expenses 62,739. I need the net income. Net income I can calculated on the basis of difference in financial, which is 11053. Okay. So as this minus number is more, okay, if you calculate 62 plus 11, it should be somewhere around 72, 73. Okay. So that's why we need to reduce, or it could be the currency loss actually. 6 minus 6854. No, it is gain. Okay, so 6854 is my additional gain. Are you able to understand? See what I
No, sir, it's little confusing.
okay. What I did, okay, or first we just see in a remeasurement what exchange rate we apply where, and then we go to the calculation part. Okay, so for income statement, like the cost of goods sold and the depreciation, that rate we need to use different, otherwise all basically the weighted average. Luckily, cost of goods sold, a historical rate is equal to the weighted average. That's why you will find the same number. Clear on this part? Why the cost of goods sold and the sales, we use the same rate what we use for the sale, just because it is a coincidence, just because the rate are same. Okay, like see, I tell you, for 3 month 0.1, for 3 month 0.1, for 3 month 0.13 and 0.18, 0.13, and for 3 month 0.18. Okay, as this month are equal, that's why the weighted rate is same as per the historical rate. Okay, and the inventory is the same amount. Inventory is the, or the purchase is the same amount. Okay, so that's why the historical rate is same with the weighted average. But if the month is different, like 4 and 2, so historical rate and the weighted average rate get changed. Weighted average rate depend on this rates. Okay, whatever the monthly rate. Okay, but like if the inventory amount get changed or the monthly purchases are changed, then the historical rate and the weighted average rate is not same. Okay, so this is basically the historical rate. This is basically, sorry, this is basically, yeah, historical rate, and this is basically the again historical rate. Okay, so that we need to consider. Because we purchased the asset on December 1st, so that's why we need to take a rate for this applicable as on December 1st. And here, because we evenly purchases the inventory, so that's why we need to consider the weighted average rate. Okay, rest all we need to use for the income statement weighted average rate. Okay, we are talking about remeasurement only. Clear about the rates? For balance sheet, all the non monetary item we need to use the closing rate. So it is 0.10. Cash, account receivable. Inventory we need to use the historical rate, but inventory we consider evenly distributed. So that's why weighted average rate is applied. Asset we purchase on the first day of the year, so that's why 0.8 applied here. Okay. In a liability, the only common stock we need to use the historical rate. Otherwise, current liability we need to use the closing rate. Clear here?
Nothing is mentioned in the inventory and fixed asset. What we have to assume? Which rate?
Okay. See, what they gave in a question, inventory was acquired evenly throughout the year and sales were made evenly throughout the year. So, if we purchase throughout the year same amount, okay, so that's why for first 3 months, say for 10,000 per month. So, for first 3 months, 30,000 multiplied by 18, second 3 months, 30,000 multiplied by 0.3, next 3 months, 0.10, and after like last 3 months, 0.10, because we purchase evenly, so automatically it becomes the weighted average. Okay, fixed asset we acquired on the first day of the year, like on December 31st year 1, the rate applicable on that date is 18. So that's why the historical rate for the asset is 0.18 and the historical rate for the inventory is 0.1275. Means it is basically the weighted average of all four rate. Clear?
No, sir, I mean to say if nothing is mentioned in the question in the
No,
examination,
in
what?
exam you will get the rate. Weighted average rate you will get it in a question. Um, then historical rate you will get it in a question. You do not require to calculate. And like closing rate you will get it in a question. What you need to do or what you need to answer, if they ask for remeasurement method or temporal method, then you need to know which rate apply to which item. That you need to attempt. Okay. For other operating expenses, you need to use the weighted average, but for cost of goods sold, you need to use the historical rate. And the same is in balance sheet. Like for non-monetary item, you need to use the historical rate, this one. Okay. And for monetary item like cash, account receivable, account payable, long-term debt. Okay. For that, you need to use the closing rate. For equity, you need to use the historical rate. Clear?
Oh,
Now, how to recognize the gain and loss, that we will see. Okay. So, whatever may be the amount in a local currency, that we apply the exchange rate and we find out the values. Okay. So, differences we need to see. First difference in a remeasurement you need to calculate in the balance sheet. Okay. So, whatever may be the differences arises, this is basically your retained earning. Closing retained earning, I can say. Okay, this is the first year of the balance sheet, so you will not see one more calculation. So my closing retained earning, say for 11053 here, which is given, that is basically the difference in the balance sheet. And opening retained earning, okay, is say for X amount. So how much amount I supposed to get from the PNL or income statement? 11053 minus X. Okay, as this this is the first year, so that's why the amount is 0. Okay, so here again 11053, same amount I supposed to get it from the PNL. Okay, so this is basically the plug one in a balance sheet. First, you need to calculate the difference in a balance sheet, closing retained earning. Okay. So, once you have the closing retained earning, what you are going to do here, that you need to fix up here 11053. Okay. You have the translated or yeah, translated, I need to use the word sales in a functional currency. You have the translated total cost in a functional currency, and you have the net income in a functional currency. So whatever may be the difference arises, that is your currency gain and loss. Clear? Which we calculate like this. See, this is the calculation. Revenue minus expenses minus net income, whatever may be the amount, this is my currency gain and loss. Any
so
doubt?
the net income for remeasurement method,
Huh?
the 11053, we can also see in the retained earnings statement as well.
Correct, correct. So this is
Yeah.
11053. Okay, we should go to the retained earning. See, in retained earning, what happened? As I said, opening balance is 0, which I'm trying to explain here. Where is that?
Mm-hmm.
Okay, like opening balance is 0. Okay, I got the closing balance. Okay, then whatever the opening balance I have, the difference is basically coming from the income statement. So if you see here, the required earning beginning year, it is 0. Net income is this one 11053, and that's why the retained earning year end is this one. Okay, generally we do in a different way. 11053 I can get it I can get that amount while balancing the financial statement balance sheet. Okay, then opening I am aware, maybe I can get in the question, and then I can compute what is my amount I supposed to get it from the income statement. Clear?
Okay, so basically 11053 we get from the balance sheet item.
Yes, we get the balance sheet item. We can get the balance sheet
Okay.
item. So it is not the retained earning amount. It is basically the difference in, means whatever may be the amount appear in an income statement, that should be the difference in opening retained earning and the closing retained earning. Here the opening retained earning is 0. So that's why whatever may be the closing retained earning, that we consider as a net income. That point means, are you clear with this point?
Yes, yes, sir.
Okay. And if I apply the net income, I need this amount, and there is a difference in, because while conversion we are using the different rate, so difference is going to be arise. Okay. So that we need to consider as the currency gain and loss, and that we calculate revenue minus expenses minus net income, whatever may be the amount arises, that's it, that is my currency gain and loss. Clear?
Okay. Yes,
Okay,
sir.
so that is basically in case of the remeasurement. Now we need to see the translation. In a translation, PNL, the single exchange rate, which is weighted average. So that's why there is no question of difference arises. So you can calculate the PNL immediately, and you know the current year net income amount. Okay, just a minute. Like 5354, this is your net income. So in PNL there is no currency exchange gain and loss you will find, because you are using the same exchange rate for translation method. Now you need to apply all this in a balance sheet. Okay, so for like if you see here 5434, you can add in your retained earning. It is opening retained earning is 0, so we need to consider 5354 as it is. Okay, otherwise opening plus 5354. Okay, now you can see the exchange rate which we applied. PNL clear single exchange rate, which is weighted average one. In the balance sheet, we are mostly using for all asset and liability the closing exchange rate. Only for the equity, we are using the historical exchange rate. Okay. So, historical exchange rate means either the opening exchange rate, if I issued the equity during the year, so whatever the exchange rate applicable on the date of the issue, that we need to apply. So because of that reason, there is a difference. Okay, return earning we are getting from means two reasons. One is basically we are applying the different exchange rate for the return earning. So that is also the issue. And the second is opening exchange historical exchange rate we apply to the equity. So whatever may be the amount arises or the difference arises, that is basically my accumulate. We need to carry rotate through other comprehensive income, and that goes to the accumulated balance of other comprehensive income. That happened in the translation method. In translation method in PNL, we do not require to recognize any plug. Okay. Then whatever the amount arises, that we need to add in a retained earning, and then whatever may be the opening retained earning and the retained, I mean whatever may be the retained earning, that we need to add, and after that we will get the difference. Okay, that we need to recognize or the rotate through other comprehensive income. Difference
So
mainly
in the balance,
we are getting because different exchange rate we are using for the conversion. Yes, Hardik. Yes.
in the balance sheet item, the accumulated depreciation, why they have considered it? Shouldn't it be reflecting in the P&L item? Why they
Accum-
have accumulated?
accumulated depreciation is basically okay. So that is the account. See what happened. One effect goes to depreciation, and the second effect goes to accumulated depreciation. See, fixed asset,
Mhm.
say for I buy it for the 1 million, and I consider the 10% as the depreciation rate. Okay, so it is basically the 100,000. Okay, so one means I need to credit in a accumulated depreciation. So you can see here in a balance sheet it is given in the negative, and the depreciation expenses. Okay, so if you see, because this is the first year, so that's why the same amount should reflected in a income statement. So here minus 22,000. If you see the depreciation,
Yes, sir. So the net effect will be zero.
yeah, net effect is 0.
Okay.
Okay. So it is just a presentation. We need to reduce the value of fixed asset. Sometimes they may give the combined means 275 minus 22. That also you may get in an examination. Okay. So here there is a, in translation method, there is a only one plug which is in balance sheet. Okay. And in remeasurement method, there is a two plug. First, you need to calculate for the balance sheet item, and then we need to calculate for the income statement in a remeasurement. Clear? Mostly you need to memorize actually what exchange rate we need to apply to what income statement or the balance sheet item under what method. That is the case. Okay, in remeasurement, keep in mind all the balance sheet P&L item we need to use the weighted average except for the cost of goods sold, depreciation and the amortization. Cost of goods sold, depreciation and amortization, we need to use the historical method. Okay, in the balance sheet under remeasurement method, we need to apply the historical rate for the equity section or the common stock section, capital section. Then the non-monetary asset are fixed asset plus inventory and the non-current liability. For that, we need to use the historical rate, and the equity always at a historical rate. For all other balance sheet item, mainly the current asset, current liability, we need to use the current exchange rate. Okay. In translation method, all income statement item we need to use the weighted average. For all balance sheet item, we need to use the current exchange rate. Only for the equity section, we need to use the historical rate. Clear? Any doubt? Okay. So derivative instrument. Okay. So derivative is basically, how I can say, means there is a primary contract, and against that there is a secondary contract. So primary contract is sell or buy for particular product. Okay, when there is a continuous changing in the value. Okay, so secondary contract is fixation of the value. Okay, fixation of value means I am going to buy 100 ton aluminium. Okay, so this is my primary contract. Okay, but the rate is basically depend on the daily changes. Rate is depend on daily changes. Okay, so if the contract says like the particular person going to buy 100 ton every month, okay, for next 12 months, for next 12 months. Okay, so in that situation, every month rate is different. Okay, if I want to protect my loss or I want to fix the rate, okay, for entire year, so secondary contract is basically the rate contract. Whatever may be the rate in the market which is not applicable, whatever may be the rate fixed by the both the party is considered as final rate. or prevailing rate. Okay. So primary contract is sale of aluminum. Sale of aluminum. And the secondary contract is fixation of rate. Clear? Any doubt here? So we can go ahead. See what happened if the rate decided by the market. Okay, so there is a daily changes in the rate. The derivative or the forward contract is not applicable to our day-to-day transaction. Keep in mind. Okay, so whenever we are working with the high volume, high quantity, and the market decide the rate. Okay, so that's why it is a risk for any businessman or the any person. Okay, so there is a requirement of the aluminum for my production. Okay, but rate may change depend on the market. Okay, so that is a risk for the any entity. Okay, so protect against this risk, they may enter into a second contract to fix the rate. That is basically the derivative. So why we are saying derivative, second contract is basically derived from the primary contract. If the primary contract is exhausted, there is no meaning to the secondary contract. Means if there is no requirement for sale and buy of the aluminum, okay, so what is the meaning? The fixation of the rate contract. Okay, so secondary contract always depend on the primary contract, or secondary contract derived from the primary contract. So that's why we need to consider this as a derivative. Generally, derivative contract is the secondary contract. Clear? Any doubt here? Okay. So there are three type of or the four type of derivative contract. Forward, future, option, and the swap. Okay. In forward, what happened? It is basically customized contract. Okay. But both the parties are under obligation to execute their part. To execute their part. Okay. But it is customized, not standard. Okay. So what happened? Like you can take an example. The one person who want to sell some aluminum at a particular rate. Okay. And the other person want to buy the aluminum at that rate only. So they enter into the forward contract. Okay. Now in a forward, what happened? Both need to perform their obligation. Like the person who undertake the responsibility of the selling, he need to sell at a particular rate, whatever may be the market rate, and the other person who take the undertaking to buy the aluminum, he need to buy whatever may be the market rate. Okay, so why it is whatever may be the market rate? See, I'll just give an example. Say for they enter into the forward contract for 1 ton buy or sell may happen with 10,000 US dollar per ton. Okay. Now the market rate is, after 1 month, market rate is 8,000 US dollar. Okay. So the person who is selling, he would be happy because he is getting a 10,000. He can sell at a 10,000 US dollar, means which is more than a that period market price. So he is happy. Seller is happy. Okay, so no issue from the seller side, but the buyer may not happy because he can get the product with a lesser price. Okay, in a market. Okay, but in forward, what happened? both need to fulfill the condition, whatever may be the situation. Seller need to sell at a 10,000 US dollar and buyer need to buy at a 10,000 US dollar. They both need to fulfill their condition. Okay. So if tomorrow it is 7,000, again it is basically the compulsion on both. The seller need to sell at a 7,000, in even though he can sell at a profit in a market, but he cannot, he need to under obligation to sell to the buyer at a 7,000 US dollar. Okay. And the buyer can buy at a 7,000 US dollar. Okay. So both need to perform their obligation. It happened in the forward. Okay. In a forward, again, the difference is only for a, means it is a customized contract. Okay. Across the counter, I can say. Okay. In future, the same concept. Okay. Both parties under obligation, but it is basically through exchange. It is somewhere monitored transaction. Okay, it is routed through some like the portal or some through the exchange. Okay, so that's why like it is not the customized. I mean, there is a fixed lot size that in a future you can buy it. Okay. And the exchange is basically the intermediary between the transaction. In a forward, it is basically the two separate people can do the transaction on their own, but in future you need to go through the exchange only. Okay, so it is quite systematic future. Okay, it is not the customized. Okay, so that is only the difference. But in forward and the future, both parties are under obligation. Okay. Then option. Okay, in forward and future, okay, one point also. If it is a sell, so we say it is a short. Okay, if it is a buy, then we say it is a long. Okay, this word also you need to keep in mind. Sell means short, buy means long. Okay, this terminology mostly used in the forward and the future contract. Okay, now we see the option. In option, there are two party. One is buyer of the option. Okay, and the second is underwriter. Okay, so execution of the contract is obligation for the underwriter. Okay, but buyer of the option, it is optional. He can avoid the contract. Okay, so that's why we called as an option. But the underwriter need to fulfill the contract. He needs to accept the contract. Clear? Okay, so that is basically the difference in forward future and the option. In forward future, both parties need under an obligation to perform their duties, but in option, the one party enjoys the right or he is allowed to non-perform. I mean, see, he is okay with the non-performance. Okay, but the underwriter is under obligation to perform his obligation. Okay, so this is basically the option. Okay, so say for like price is 1 ton of 10,000, agreed option price, okay, and the market price on that date is 8,000. Okay, say for like the buyer of the option, he have an option to buy. Okay, and the underwriter is under obligation to sell. Okay, so if the decided price or the option price is 10,000 and the market price is 8,000, buyer may decide instead of exercising the option, it is better to buy in the from the market. He may decide not to exercise the option. Okay, because he is in the market, he is getting the higher rate. Okay, so in that situation, seller is under obligation. As the buyer is not exercising the option, seller cannot enjoy the profit. Okay, so he has whatever the premium he may receive for his obligation, that is the only profit he can get it. Okay, and the buyer can buy with a 8,000 market price. Okay, so that happened in case of the like option to buy. Okay, the same way option to sell. Okay, so if like buyer of the option has the right to sell, okay, and the market price, I mean the decided price is 10,000 and the market price is 12,000. So buyer of the option may think instead of selling at a 10,000, it is better to sell in the market at a 12,000. Okay, so he have an option to not to exercise the option. Okay, underwriter, he may in a loss, okay, because he's supposed to buy at a 10,000, okay, but now like he need to buy at a 12,000, okay, because the option of the buyer of the seller option sell, okay, so he decided not to sell to the option underwriter. Instead of that, he can sell to the open market with a higher price. Okay, so this way, in an option, one party is not under obligation, the other party is under obligation. The one party has a option to exercise the contract or allowed to expire the contract. Okay, so that is the like option contract. In option, buy means call option and the sell means put option. Okay, beside that, you just need to keep in mind, purchase of the option or the purchaser of the option is basically enjoy the right to expire or enjoy the right of option, but the seller of the option under obligation is under an obligation. Clear? Any doubt here? Okay. Okay. So underlying is basically the specified price. Okay. Notional amount is unit of measurement. Okay. So like means specified price is basically the 10 dollar is basically the price. Okay. And the 200 liter or ton, this is basically the how I can say notional amount, and the value of settlement amount is basically this multiplied by this. Payment provision hedging. Hedging is basically means what we are means that I will explain. Okay, so option contract, common derivative. Option contract we already discussed. Okay, so we can take an example. See, hedging what happened means okay, if a particular person for his manufacturing process, okay, he need to buy 100-ton aluminum. Okay, now what happened, if he is buying an 100-ton aluminum, it is required, okay, he need to buy it. Okay, so there are two ways, either he can enter into the forward contract, okay, for what is basically the word I use for a purchase in a forward and future. Anyone can recollect? I use the four words long, short, call, put.
Long and short for the forward and future.
Yeah, so long is for the purchase. Okay, okay. So either he can do with a some like seller. Okay, I need 100-ton for a particular rate. Particular rate. This is one option. Means he directly decide the price and fix the price. Okay. The second option is basically he may enter into the future contract on exchange. Okay, as he need to buy, okay, for a particular rate, enter in the future contract for the sale of aluminum. Okay, and now you can imagine how we hedge actually. Sale of aluminum per month 100 ton. Okay, the price is basically the 10,000 fix. Okay, if tomorrow the price is 8,000, okay, so he can buy from the open market at a 8,000. Okay, he has a sell option, so he can again buy at a 8,000 and he can sell it at 10,000. Okay, so he can execute the contract. So his price is basically remain as it is 8,000 and he may get the profit here. Okay, if the price is 12,000, okay, price is 12,000. No, it is reverse actually. Instead of sell, it is buy at a 10,000. Buy at a 10,000. Okay. So in this situation, like he can buy at a 10,000. Here he can buy at a 10,000 and he can sell at a 8,000. So whatever may be the minus 2,000 losses, minus 2,000 losses, that is basically compensated here. Here basically because instead of 10,000 he can buy at a 8,000. So there is a profit of 2,000. So this way this losses get like compensate each other. That is basically the hedging. Okay. And the same way if the rate is 12,000, so he need to buy at a 12,000. Here he can buy because he has a future contract to buy it at 10,000 and he can sell it at 12,000. So here he will get the profit of 2,000 and whatever may be the loss of 2,000 that get compensated. That is basically the hedging strategy.
So, sir, future contract is made for the purpose of buying or selling.
No, you can do for anything. It is not
Okay.
necessary for buying or selling. You can do for anything.
But tomorrow, if the rate is increasing to 12,000,
Hmm.
I'm not interested to buy for 12,000.
No, if the rate is 12,000, okay, you need to buy for your like physical quantity you need to buy for your manufacturing process, okay. But here in a market you can buy it at 10,000 and you can sell immediately at a 12,000. So you are able to get the profit of 2,000. See, in future, what happened? You are basically route. It is not the physical delivery. This is basically like we need to trade on a exchange. Okay, so you will get the profit here because you have a right to buy at a 10,000. Okay, and you can sell in the market at a 12,000. So 2,000 is profit. Whatever the physical delivery you need to get it at a 12,000. So there is a loss of 2,000 that get compensated.
So basically, we doesn't have a profit or
There is no
loss.
profit or loss. Okay, so that's why we call this as a hedging. We are protecting ourselves. Okay, so that is the basically the hedging. Okay, so that I basically apply to the when there is the transaction related to the under obligation. Okay, so that's why I just I mean the physical delivery and plus future contract we entered into the future contract or I mean the physical delivery also we can approach to the supplier or the seller for the price fixation, and for that we called as a forward contract. Okay, in a forward contract is a customized contract, means you need to buy for your manufacturing consumption at a particular price. That is basically the forward contract. Okay, finished. In a future, you are physically delivery you are taking from someone, and exchange you are doing the same trade or the same material, same quantity with a market rate. So you can comp off your profit and loss. So that is forward and future. Now in option, okay, if I purchase the call option, purchaser always have an option, call option. Call means right to buy, okay, for $100. Okay, if tomorrow for commodity X, okay, if tomorrow value of commodity X is 120, okay, so you are going to exercise the option because you have a right to buy at 100, okay, and if it goes like 80, so you may allow to expire, you are not going to exercise your option, and in a market you are able to get the same quantity at 80. Okay, so means either you can gain from the market or you can restrict your loss from the market. That is basically the option. So in option, always the maximum loss is whatever the premium paid to buy option. That is the maximum loss for the option holder. Clear? Okay, we can see this example. So on January 1, year 1, Robert Company purchased a put option on the stock of Buy Big Inc. The option gave Robert the right to sell. So right to sell means which option? It is given in the put option. Yeah. Okay, he has the right to sell of buy big stock at a $75. So he has a right to sell at 75 US dollars, selling right. Okay. During the next 30 days, Robert paid a premium of $2 per share. What is the premium? $2 per share. Okay, per share. Robert exercised the option when buy big stock was selling for 69 per share. Okay, so if the price is 69, means the current spot rate is 69. Okay, so it is basically the lower price. Okay, so what happened, he has an option to sell at a 75. So what he is going to do, either what if the he has a share in his hand, so he can sell directly at a 75, and whatever may be the profit arise, that is basically the profit. Means if you don't have an option, then he need to sell at a 69. Okay, so here profit is 6, okay, on selling, minus 2, which the premium he paid. So 6 minus 2, 4 is his net profit, like this. Okay, so we will see the 10,000 shares. Okay, so net initial investment is 20,000, and the settlement amount is basically the 7,50,000. Okay, so Robert could either deliver 10,000 of big buy stock to the option writer in exchange of 7,50,000. Note that this shares could either be shares already owned by Robert or share purchased by the Robert 6,90,000 from the market. Okay, either he has the existing share or he can purchase from the market and then delivered it to the option writer. Either way, Robert realizes the gain of 60,000 minus 69 plus 10,000, and the option writer realizes the loss of 60,000 because of the option writer must pay 75,000. the option writer could pay Robert 60,000 to settle the contract, and this is the net settlement. Okay, because 20,000 was paid to purchase the put option, Robert will report a net gain of the 4,000, like 4,000 multiplied by 10,000. That is his net gain, 40,000.
So, sir, in this example, the premium amount, the underwriter will be having the premium amount, right?
That
So,
is profit
the
for it. Yeah, absolutely. So it is the 40,000 gain to the Robert, and the same amount underwriter loss for him, because he means the 6 rupees loss for him, and but he recover the -2 in terms of the premium.
okay,
So ultimate loss is 4.
okay,
Okay. So that is basically the put option. Okay. And here, if the price instead of 69, the price is 80, say for. Okay. So what Robert may do, he can he may go with the expiration of the contract. He can sell the shares at a 80. Okay. So whatever may be the price, means if because he has a 75 is basically the his selling price, but now he can able to sell at a 80. So $5 per share is an additional profit, and whatever the premium pay is a -2. So $3 per unit per share is the profit for him because of option. Are you able to get me?
so, but if the share value is 80 rupees after 1 month or after the next day, so the robot can do the call option, right? He can buy more shares.
No, no,
He can apply the call option.
no, he can. He don't have a call option, na. He has the put option only.
Okay.
Okay, so it is not like this. Okay, the only thing is that generally people are buying a put option when they have a certain shares in hand. If they are doing in a such a way, then they will do the big messed up. And that's why if you see like the futures and option, there sometime there may be a huge losses. Or he may, if I consider this way also, 80 is the like selling price, and he want to square off the transaction. So 80 is the buying price, so it get nullified, and whatever may be the premium he pay, that could be the maximum loss to him. So option holder, always the maximum loss is basically whatever the premium he paid. That point also you need to keep in mind.
He can have the hedging facility, right?
You have an
Hedging.
hedging. It is a part of hedging. That is the hedging actually,
Okay.
because you have an option. It is not necessary that you are under obligation to execute the contract. Means if this is, he don't have a like existing share, so why he is going to buy and sell? He will allow to expire the contract. He don't require to buy anything. Means he is not going to buy at 80 and the exercise the option of 75. Allowed to expire. So maximum loss is basically whatever he paid the premium in an option. So that is basically the hedging. Means you are going to somewhere restrict your losses.
Sir, and the option contract is valid only for 1 day, right?
No, it is
In the
not.
same day you have to
No, it is
exercise.
not necessary. Sometimes it is a 30 days, 15 days, 90 days, depend on the terms.
Okay. Okay,
Okay,
sir.
but generally for a short period, because no one is going to enter in a long-term contract, because the underwriter is also going to take a risk with some evaluation.
Okay.
Okay. Now we see the future contract. On January 1, year 1, the Jones company entered into a long position. Long position means buying.
Okay.
Okay. So we are right now calculating for the Jones and company. So he purchased means right to buy. Okay, of a future contract in which it agreed to pay $1 for oh sorry, 100,000 euro for 1.67 dollar per euro on April 1 year 1. On April 1 year 1, the spot rate was 1.74. Okay, so he is an under obligation um, to buy at 1.67. Okay, so underlying amount is 1.67 dollar per euro and the notional amount is 1 million. Initial net investment is 0. Okay, so settlement amount is basically it is 167,000. Okay, so derivative could be settled in the following ways. Okay, on April 1 it is the 1.74 dollar. Okay, so what happened here, he can buy at a 1.67. Okay, and the rate is 1.74, so he is going to gain a profit. See, Jones could pay 1.6, receive 100 million euro and could then realize 7,000 gain. I mean, what happened, he has a buying authority or buying under buying obligation and the rate is 1.67. Okay, so if I buy 1 million euro at 1.67, so he need to spend 167,000 US dollar. Okay, and like whatever maybe the 1 million euro he 100,000 euro he has, okay, that he can sell at a 1.74 because he has a obligation to buy at 1.67, but in open market he can sell at a 1.74. Okay, so this is basically his purchase amount. Okay, his sell amount is $174,000. Means what he did, whatever the 100,000 euro he buy in option, sorry, future, for that he paid 167,000 and now he sell at a closing exchange rate, it is 1.74, so 174,000. So whatever may be the 7,000 is basically the profit for him. Clear? Now, if the spot rate on April is 1.59, okay, so instead of 1.74, it is 1.59. Okay, so here it is not like this option is getting lapsed. Okay, he need to buy because it is a future or forward contract. Both the parties are under obligation. Okay, he need to buy at 167,000. He is able to realize 159,000. Okay, which is sell value. So this will give the loss of 8,000. It is basically loss for only 159,000. So that is basically the loss for it. Then future contract. Okay. So forward contract we just discussed. So forward contract are similar to future except that they are privately negotiated between two parties with the assistance of an intermediary rather than through a clearing house. Okay, so forward contract do not have a standardized notional amount for the settlement or the date, and the terms of forward contract are established by the parties to the contract. Okay, so that is basically the forward contract. Okay, now swap contract. Okay, so we can take a break here for 15 minutes. So somewhere we'll join around 8:45 and then I will start with the swap contract. Okay. Okay. So I hope I am audible properly and visible as well. Yeah. Swap contract. In swap, first condition is basically there should be a series of payment. Series of payment. Okay. For example, if we took a loan, okay, then there is an EMI, and EMI we need to pay in a monthly basis or yearly basis or yearly. Okay. So EMI is basically the series of payment. Okay. We enter into the swap transaction because of two reasons. One is basically the exchange rate, and the second is interest. Okay. Exchange rate I will explain. Okay. Interest rate, what happened? There are two types, the fixed interest rate and floating interest rate. Okay. So mostly the salaried people preferred the fixed interest rate. Why? Because their salaries are fixed. But the businessman, okay, they prefer floating interest rate because their profitability or the turnover depend on the economic situation, and accordingly if the economy is good they can absorb the higher exchange rate, a higher interest rate, and if the economy is bad then they are okay to go with the lower interest rate. Okay, so that's why they are more okay with the floating interest rate. Okay, but generally for the businesses they can get the loan with a lower interest rate when the interest rate is fixed, but the salaried people they can get the loan with a lower interest rate when it is a floating. Okay, so desired is this one. Okay, but they are getting this one. Okay, so to avoid this situation means the salaried people who need the fixed interest rate, if they are getting the floating exchange rate, okay, and the businessman who need the floating exchange rate, but they are getting at a fixed exchange rate, so they will swap their obligations. Okay, say for the salaried people took a loan of 100,000. Okay, and the businessman is also took a loan of 100,000 with a floating interest rate, with a fixed interest rate. So what they are going to do, they whatever may be the EMIs, okay, that they will exchange. Okay, so what they are going to do, they keep the loan amount as it is, but the EMI obligation get exchanged. Get exchange, that is basically swap. Means like the salaried person enter into the contract with the businessman for the exchange of EMI. Okay, so salaried person getting an EMI with a fixed amount and the businessman getting an EMI with the floating amount. Okay, so that is basically EMI obligation get change. Okay, so that is basically the swap contract for the interest rate. Okay, so now you can understand. Okay, assume salaried person get the 8% as an interest and the businessman get the 9% as an interest with a, like he got the fixed one and he got the floating. Okay, so now they exchange their EMI because he need the fix. Okay, so what happened? The first year, I'm just calculating the with respect to interest, not I'm considering the EMI just for an example. Okay, so salaried person need to pay the interest of 9,000. Sorry, means the business one obligation is 9,000 and the salaried obligation is 8,000. which they are going to exchange. So salaried person need to pay 9,000. Okay, and the businessman need to pay 8,000. So how they are going to do the settlement? Salaried person will pay to the bank 8,000. Okay, and he paid to the businessman 1,000, like this. Okay, tomorrow the exchange rate, like the businessman exchange rate, interest rate is fixed 9%, but this exchange rate increased to 10%. So obligation here is 10,000, and here as it is 9,000 fixed. So in that situation again, the 9,000 obligation taken care by the salaried person and the 10,000 obligation taken care by the businessman. Okay, so in that situation what happened? The salaried person pay to the bank 10,000, and he can recover 1,000 from the businessman. So his net obligation is always 9,000. Here also 8,000 to the bank plus 1,000 to the businessman, and the net obligation is again 9,000. So this way this transaction get managed. Okay. So that is basically the interest rate. Okay. We will see this example.
And in that example, if any person defaulted in the payment, then
Okay,
what will
so
be the
yeah,
cost?
understood. Okay, so that we will discuss actually in any contract, not only the swap, even in if you see the forward, because in future generally there is no default because it is routed through exchange, but in option as well as the forward, there is a high risk of default. Means okay, underwriter is under obligation to execute the contract. Okay, but he is bankrupt. Then no option. Means you cannot do anything. Okay, so the same way salaried person may default, or the businessman also may default. So that is basically the credit risk or the market risk which we can say. Okay, but that risk is there. Okay, at this moment we just consider means how we are, I mean, see, there are certain natural transactions, and then how we can, I mean, if we cannot manage with the natural, then how we can hedge. Okay, so that's why we are considering this. Like the salaried person can get the loan or at fixed interest rate, sorry, floating interest rate only, but he need the fixed one, fixed interest rate. So how he can hedge his risk? Okay, so that's why he can approach to the someone who has a fixed interest rate loan, and then he can exchange the EMI. Okay, but of course there is a credit risk, there is a market risk, all risk other than means the interest rate, all risks need to bear by the salaried person or both the party actually.
Okay, sir.
Yeah. So on January 1, year 1, East Company and West Company entered into an interest rate swap in which East Company agreed to make to West Company series of future payment equal to the fixed interest rate of 8% on a principal amount. In exchange of West Company agreed to make East Company a series of future payment equal to floating interest rate of SOFR plus 1% of the principal amount of SOFR. So secured override financing rate. Okay, so it is basically the whatever may be the current SOFR plus 1%. Measure the cost of oversight borrowing through the repurchase repo transaction collateralized with the US Treasury security and is common benchmark for the interest rate swap. Okay, so underlying 8% and the West Company SOFR plus 1%. Okay, so underlying means what happened is company want to pay East Company agreed to make a payment with an interest rate of 8%. So they want to pay with the fixed interest rate, and the West Company want to pay with the floating interest rate, but they have a alternate arrangement. Okay. So initial net investment, no cost. Okay. So see, EMI they are paying as it is. What they are changing, difference in the interest. Okay. So that's why there is no initial investment. Okay. Settlement amount, East Company 8% multiplied by 1 million, which is 80,000, and West Company, whatever may be the SOFR plus 1%, say for it is of 1 million. Okay. So on the first settlement, SOFR was 8.5%. So following amount were exchange. East Company like 80,000 he need to pay to the West company, and the West company need to pay the 95,000. So settlement is generally at a difference, which we just discuss here. Clear?
So what is SOFR? Like,
No, no, it
how
is
does that
no. That is
happen?
basically the government dictated rate. Okay, so like there are again certain terminology I'm not able to recollect.
So
Mm,
that will be fluctuating every time?
every time it get fluctuate.
Okay.
Okay, so it depend on the economic situation. Okay, so generally, even if you see the housing loan and everything, okay, so it is basically, I mean, in your loan document, it is whatever may be the repo rate plus 2% or the 4, means if the housing loan, then it is a 1% or minus 4% like this. But in consumer loan, it is basically the whatever may be the repo rate plus 5% like this. Okay, so repo rate is given by the RBI. So this is like that SOFR. So SOFR keeps on changing. Okay. So derivative risk we just discussed. I mean, there is a market risk, credit risk. Market risk is the risk that the entity will incur a loss on the derivative contract, as demonstrated in the example above. Derivative are a zero sum game. Every derivative has a winner and the loser. Okay, so basically, see, someone is going to gain, someone is going to lose. Okay, but the market risk is basically means if the commodity is not itself not available, then there is a no point, or it is difficult to perform the obligation. Okay, credit risk is that the other party to the derivative contract will not perform according to the terms of the contract. For example, if the interest rate swap example above, each company faces the risk that West company will refuse to pay the net settlement of the $15,000. So that is also possible. Okay, so it is basically in every obligation actually, because the one person is underwriter, and if he defaulted, then there is no meaning to the option except future. In future, generally, because it is routed through the exchange, so they are keeping some deposit, and the contract is standard. So if someone is not obligated, so they can deduct the losses from the deposit. So in future, there is a less risk, but otherwise option as well as forward and the swap, there is always a market risk or the credit risk. Any doubt here? Okay. So in balance sheet, okay, you need to recognize all derivative at fair value on the reporting date. Okay. So like all the derivative measure fair value and recognize in the balance sheet. So either in asset or liability, depend on the right or obligation under the contract. So accounting for changes in the fair value of a derivative is depend on whether the derivative has been designated and whether it qualifies as a hedge. So we need to see. Okay, when we say the hedge accounting, okay, so to qualify the hedge accounting, following must be documented at the inception of the hedge. So hedging relationship, the entity's risk management objective and strategy for undertaking the hedge, including the identification of each of the following: the hedging instrument, the hedging item or transaction, the nature of the risk being hedged, and the mention that will be used for the assess the efficiency of the hedge. Okay, so when we say the hedge, when we enter in the transaction to reduce the risk, like I am buying a future contract to reduce my loss against actual purchase of any aluminum. Okay, so that is basically the hedging contract. Means if your intention or strategy is basically to reduce the risk or manage the risk, then we can say this is an hedging. Okay. If this is not the situation, means we are not managing the risk. Okay. So there is no any how I can say the other element or the contract. Okay. But we enter into a derivative contract. Like I decided or purchase an option to buy particular share at say for $20 after 3 months. Okay, so in that situation, I just decided to buy at a 3 month because I feel the prices may go up. Okay, just feeling that prices may go up. So if this is the situation, then what go up? What we are? I mean, what could be the? We need to consider this kind of transaction. Anyone can guess? Means there is no intention to manage the risk. Just I feel the prices may go up, and because of that reason, I may enter into the option contract with a lesser price. Means say for I feel the prices may go up to $30. Okay, and that's why I enter into that. Option contract, call option, that I can buy after 3 months at a $20. Okay, so there is no intention to manage the risk. I mean, so what we can say this kind of transaction. Can you guess? This could be the speculation. This is not the hedging strategy. Hedging strategy means the transaction is same, but if it is with the intention to manage the risk, then we can say it is an hedging strategy or hedging transaction. Okay. So reporting gain and loss, no hedging designation. Gain or loss on a derivative instrument not designated as an hedging instrument are recognized currently in the earning to the income statement. Okay. So if this is related to the speculation, then we need to recognize in a income statement. Fair value hedge. A fair value hedge is okay. A fair value hedge is an instrument designated as a hedge of the exposure to changes in the fair value recognized as an recognized asset or liability, or of an unrecognized firm commitment that are attributable to the particular risk. Gain and loss on such instrument as well as offsetting gain and loss on the hedge item are recognized earning in the same accounting period. So derivative must be expected to be highly effective in offsetting the fair value of the hedge item. Okay. So a fair value of hedge is used to manage an exposure to changes in the fair value of the recognized asset or liability. Okay. So like fixed rate debt or an unrecognized firm commitment, that is commitment to buy a fixed quantity of silver at a fixed price. Fair value hedge can be either financial or non-financial item, but fair value hedge of financial asset and liabilities are more common. Okay. So see, fair value of hedge always first adjusted with the primary contract. Primary contract that we need to keep in mind. Okay, so fixed quantity of like what say for I have a silver. Okay, and just I want to protect the losses. Okay, so whatever may be the actual selling and buying in a silver, and whatever may be the fair value hedge valuation changes, that I need to knocked off. Okay, so this way we need to do the accounting for the fair value hedge. So we can see the example. On January 1, year 1, each company issued 1 million 3-year 8% fixed rate note payable. The interest is due annually on December 31st. The principal is due at maturity on December 31st, year 3. Okay. So here we need to see the valuation of my liability. Each company faces the risk that changes in benchmark interest rate will cause unfavorable changes in the fair value of the note payable before its maturity on 31st December, year 3. So to manage this risk that changes in the benchmark interest rate will cause unfavorable changes in the fair value of the note payable, each company concurrently enter into the interest rate swap and designated it as a fair value hedge. As the hedge items are in line with the terms of the hedge item note payable, the hedge is expected to be highly effective. So what happened? If it decided to pay the interest to the investor with a fluctuate rate, and if he feel that the fluctuate rate may adversely affect, so he correspondingly enter into the fixed someone, and he decided to exchange the or he decided to enter into the swap contract for the changes in interest rate. Okay. So interest rate terms, swap terms, date of designation January 1, year 1, term 3 year, counterparty Western Company. So swap arrangement for Eastern Company agrees to make to Western Company series of future payment equal to a variable interest rate SOFR plus 1% on a principal amount and one for 1 million, and SOFR is basically the secured oversight financing rate. Measure the cost of oversight borrowing through the repurchase transaction collateralized with the US Treasury. Okay, so rate in exchange of make is a series of future. So it is just like a they decided to exchange the interest rate. Okay, so underlying East Company has an obligation of SOFR plus 1% and West Company has an obligation of 8%. Okay, if SOFR at inception is 7%, so now both one has an exchange rate of 8% because 7 plus 1 is 8% and the West Company already having an obligation of 8%. So notional amount is 1 million, no net initial investment, and the initial fair value of swap is also 0 because in this situation both the parties having a same interest rate. Okay, now what happened? Assume the following inception on January 1, year 1 and the first settlement date on. Okay, so January 1, year 1 SOFR is 7%, so SOFR plus 1% 8%, and the fair swap value is basically the 0. So fair value of note payable is 1 million. Now on December 31st, year 1, SOFR is 8.5%, so it is 9.5%. So fair value is 15,000. Why this is the fair value? Because we are going to protect this rate or save this amount. Okay, so fair value of note payable is 985,000. So we are not recognizing this gain as it is. What we are doing, we are adjusting first in the obligation. Okay, now you can see cash account to note payable. It is simple. I mean, we got the amount from our investor. Interest expenses and the interest rate swap. This is an additional expenses. Okay, and the note payable and the gain on note payable. So value of the note payable get reduced. Okay, interest expenses is basically I mean it is not whatever maybe the expenses arises. Okay, so that we need to consider, like say for the 8%, and the first year it is 9.5%. So, I mean the West Company should bear this one, and the East Company need to bear this one. Okay, so additional 15,000. Okay, the swap is recorded as a 15,000 because it represents 1 million multiplied by the difference between the exchange rate. East to west. Just a minute. Okay, so okay, understood. See, Eastern Company has a fixed rate obligation, and now he decided to go for a like floating interest rate. So that's why it is okay. So East Company they have a fixed rate interest rate, and the West Company 9.5 floating interest rate, and now they decide to change their obligation. So East Company is going to take an obligation of the 9.5%, and the West Company going to take an obligation of 8%. So Eastern Company, when he pay actual 8%, so interest expenses 80,000 to cash account, but he took the additional obligation of 1.5%. So again, the interest expenses 15,000 to interest rate swap. 15,000. Okay, that is basically the obligation. And the interest rate swap, and then note payable 15,000 to gain on note payable. Okay, okay. So I hope you are able to understand why the interest rate expenses and the interest rate swap, and after that, that interest rate swap to the cash account. Okay, this is basically the 8% fixed interest paid by the Eastern Company, and the 15,000 he need to pay to the Western Company. Okay, so relation in East and Company and Western Company is basically like he has a obligation of 8% fix, and he has obligation of SOFR plus 1%. Okay, and then they decided to exchange. Okay, so now the 8% obligation to him and SOFR plus 1% obligation to Eastern Company. So currently Eastern Company bearing 9.5% interest rate, and the Western Company bearing 8% interest rate. So if the market rate is 9.5% and they are paying at 8%, so valuation of liability goes down. Okay, and the why it is valuation liability goes down, if the market rate is 9.5%, they are paying to the investor, say for 80,000. Okay, 80,000 divided by 9.5, that would be the valuation of the valuation of the liability. Okay, so this So it is roughly 8,50,000. Okay. See what happened if the 8% is the market rate. Okay. So 80,000 divided by 8%, that would be the valuation of the liability. So it is again 100,000. Okay. But or 1 million. Okay. But if the market interest rate is 9.5% and we are paying the 80,000 interest, so the valuation goes down. So which is approximately reduced by 15,000. Okay. We go one by one again. First thing, just need to keep in mind, like East and Company, they originally took loan at a fixed rate, okay, and they decided to go for a floating rate, okay. So, as per their agreement with the investor, like they raised the 1 million note payable, okay, and they need to pay the 8% interest rate, okay. So we see this transaction only. So first cash account debit to note payable 1 million, okay, then they are paying 80,000 to their interest expenses and accrued interest expenses payable or cash. Okay, this is the simple transaction with the investor. To protect the future interest rate, they decided to go with the um, floating interest rate. Okay, and the floating interest rate currently is 9.5%. So there is a gap of 15,000. So additional expenses we need to recognize, because if they follow with the fixed interest rate, then they need to pay the 80,000, but they decided to go to the floating interest rate. So that's why they need to pay the additional 15,000. So interest expenses debit and the interest rate swap credit, that would be the recognition of the additional interest expenses, which they compensate by paying 15,000 to the Western Company. So interest rate swap debit and the cash account credit. Okay. So here they recognize the additional expenses. Okay. Now they need to do the valuation of the liability. Okay. So if I consider like I'm paying to my investor 80,000, okay, and the market rate is 8%, so the valuation of liability is 1 million. Okay. But if now the market rate is 9.5% and I am paying 80,000, so valuation of the liability may go down. So that will reduce the valuation of my liability. So 1 million is basically now it is 85,000 because of interest rate. So that gain I am going to recognize. So that gain I am going to recognize here. Note payable account debit to gain on note payable credit. Okay. Why we recognize this? Say for in a market interest rate is 8% and the investment amount is 1 million. So I need to pay the 80,000. Okay. Now with the same transaction, but the market rate is 9.5%. So how I am calculating my value of the liability? 80,000, which I am paying in a cash to my investor, divided by 9.5%, which will be less than 1 million, which could be the 850,000. Okay. So that is or approx.
So, sir, but East is paying 15,000 extra, right?
No, he is paying interest to Western Company. We are just doing the market valuation of the liability. To investor, he is paying only 80,000. But earlier, the
Okay.
market rate is 8%, the valuation of liability is 1 million. But now, for the same interest rate, the market rate is 9.5%, so valuation of the liability may go down. Okay, so this is basically that entry. Note payable, debit to the gain on note payable 15,000. Okay. Then cash flow hedge. Cash flow hedge we generally routed through additional accumulated comprehensive income. Okay, so it is part of the AOCI. A cash flow hedge is an instrument designated as a hedging the exposure to variability in expected future cash flow attributed to a particular risk. So gain and losses on such instrument included in the assessment of the hedge effectiveness are reported as a component of the other comprehensive income. So whatever may be the gain and loss happened. Okay. So this is on the basis of like valuation. So we will see the example here. Okay. See, in addition to that means that 90, if you see the 1 million is basically the become the 85,000. That doesn't mean that I need to pay to my investor is 85,000 or 8,50,000, 850,000 actually. Okay, I need to pay 1 million only. This 15,000 we need to amortize over the period. Okay, in a first year, I mean that also you need to understand somewhere maybe in upcoming chapters you may get the concept. In a first year, when this gain arises, you are recognize this as a gain, and the corresponding effect goes to the 100,000 note payable less 15,000 gain. Okay. Then this 15,000 over the period of note payable, we need to amortize. Means we need to expense out on year to year basis. Okay. If I consider, means for that we need to use the discounting factor. Okay. But if I consider the straight line basis and the loan amount is for next 2 years. So in every 7,000 first year, 7,500 we need to debit, and we need to remove 7,500 in a first year. So it is basically remaining 7,500. It is the credit balance. Okay. Or it, yeah, it is the credit balance. No, it is liability. So we recognize the gain. So it is debit balance. Okay. So we need to credit this amount, and the 7,500 means this 15,000 is a debit balance, and the 7,500 means we need to do the credit, and the corresponding we need to recognize in a P&L. The next year again we need to reduce this value, and we need to recognize the 7,500 in a P&L. So it is basically this amount we need to amortize over the period. It is not like this gain in a first period and then like we need to pay to my investor the 850,000. That is not the case. Okay. So whatever may be the difference that we need to amortize over the remaining period of the note payable. Are you able to understand this point? First year we recognize the gain, but subsequently we need to recognize the expenses, and we need to reduce the value of the whatever may be the amortization, whatever may be the gain or loss. Okay, that we need to reduce. Okay. Second, on January 1, year 1, each company issued 1 million 3-year variable rate note payable. The variable rate is based on the SOFR plus 1. Okay, so here it is variable rate, Eastern company, it is not the fixed rate. Eastern company faces the risk that variable rate percent could cause an increase in the required interest related to the cash flow. So it is, I mean, now in this question, exactly the reverse situation. Okay, so they approach to the Western company for the fixed rate. Okay, so underlying is basically Eastern company 8% and Western company SOFR plus 1%. So SOFR at inception is 7%. So there is no cost. Now we need to see the same example. So journal entries must record January year 1. Okay, so same adjust. So first 1 million to 1 million, and then like here interest rate. Okay, so interest expenses is 95,000. Okay, because now they Eastern company need to pay to their interest expenses at a SOFR plus 1. So that is basically their interest expenses. Okay, interest rate swap and other comprehensive income, that is basically like 15,000 which they are gaining. Okay, so that is basically the interest rate swap debit, and the other comprehensive income we need to credit. So that is basically the other comprehensive income which they are gaining. Means here what happened, they need to recognize the expenses of 95,000, but actual interest they need to bear the 80,000. So whatever may be the income that they need to rotate through other comprehensive income. Okay. And then interest rate swap, cash account debit to interest rate swap, and the other comprehensive income debit to interest expenses 15,000. Okay, so this is basically the credit. So other comprehensive income is basically zero. Here it is credit and here it is debit. Okay, and the interest expenses is basically the 80,000 net effect. When 95,000 when they actually make the payment to their investor, and the 15,000 credit. Okay, from the other routed through other comprehensive income. Clear? So valuation of liability in the first question, I hope you are able to understand why we did 85,000 or 8,50,000 and how we are going to recover in a next years. Okay, so it is basically, even if I recognize the gain in a first year, that I need to amortize in remaining tenure of the loan. Okay, so that also you need to keep in mind. Ultimately, to my lender, I need to pay the full amount. Clear? Anyone has any doubt? So foreign currency hedge. In foreign currency, what happened? Like Indian company and the US company. Indian company has a branch in the US and the US company has a branch in India. They want to expand in a US. Okay, Indian company. Okay, so that's why they need some amount in US dollar. US company want to expand in India and they need an INR. Okay, so what happened? Indian company is going to take a loan in an INR, and the same equivalent US dollar is going to, I mean, the US company take a loan in their company in US dollar. Okay, and after that they exchange the amount. Okay, so say for Indian company take a loan of 900,000. Okay, and US company take a loan of INR. Okay, and the US company loan of 10,000 US dollar. Okay, they gave 10,000 US dollar to the Indian company, and 900,000 INR Indian company gave to the US company. Okay, and then it is remitted subsequently like this. Okay, so whatever may be the EMI Indian company need to pay, that is on 90,000 INR. Okay, and whatever may be the EMI US company need to pay, that is in 10,000 US dollar and the US currency. Here INR currency. So for Indian company, they took a loan of 10,000 US dollar in US currency, but they need to pay the EMI in INR. Clear? Okay, so there is no exchange rate risk. Okay, keep it simple. Indian company need the loan in a US dollar, but they borrow in a INR and going to pay EMI in a INR only. Okay, US company, they need the money in a US dollar, INR, but they borrow in a US dollar and they are going to pay amount in a US dollar only, EMI in a US dollar only. Okay, how they swap the transaction, whatever may be the principal borrowed by the Indian company, they exchange with the principal borrowed by the US company, and that will become the exchange rate. Like here, it is basically the 90. Okay, that is the common exchange rate. Okay, after that, because the Indian company bearing the EMI obligation in INR, so there is no exchange rate risk for them, and the US company, they need to bear the EMI in a US dollar, so for them also there is no exchange rate risk. Clear? Anyone has any doubt? Okay, So foreign currency fair value hedge, gain and losses from the changes in the fair value of the foreign currency transaction hedge classified as the fair value hedge and accounted for in the same manner as gain and loss in the fair value hedge in the earning. Okay, so that we will see. Okay, in a foreign currency cash flow hedge, gain and loss from the changes in the fair value of the foreign currency transaction hedges classified as a cash flow hedge are accounted for in the same manner as a gain and loss in a cash flow hedge. Okay. And then the foreign currency net investment hedge. Gain and losses from the changes in fair value of the foreign currency transaction hedge entered into the hedge as a net investment for an operation as reported in the other comprehensive income. Okay. So currency fair value hedge means it is just like a property. Okay. Cash flow hedge means subsequent valuation. Okay. So whatever may be the foreign currency available on reporting date. Reporting date, that is basically the foreign currency in a fair value hedge. Okay, so any obligation in foreign currency or the asset like current asset on a foreign currency like data. Cash flow is basically EMI. Okay, and the third is investment means if we hold a property like US company hold a property in India. So while converting the fair value, okay, so that is basically the investment, foreign currency net investment hedge. Okay, now accounting for changes in fair value. No hedge designation included in a current earning. So fair value hedge included in the current earning as an offset to gain and loss from the change in the fair value of the hedge item. Okay, so like if I'm going to buy the metal for my production processes, okay, and like whatever may be the gain and loss of a corresponding future contract that I need to adjust it. Okay, cash flow hedge included in the other comprehensive income until the transaction impact earning means unless and until we are not going to close the transaction. Okay, so we need to recognize in OCI. So in last example, if you see, first we transfer to OCI 15,000. Once we pay it or paid, then we need to transfer to income expenses. Okay. If it is unrealized, then we need to park at an OCI. Once we clear with the cash, then we need to transfer to the expenses account or the P&L item. Okay. Then fair value hedge included in the current earning as an offset to the gain and loss from the changes in the fair value of the hedge item. Cash flow hedge included in the other comprehensive income until the hedge transaction impact earning and the net investment hedge. So included in a comprehensive income as a cumulative translation adjustment. Okay, so net investment hedge generally we do in case of the financials. I mean, when we are converting entire subsidiary in a subsidiaries financial in a reporting currency. So that is also we need to rotate through other comprehensive income. But the second effect, I mean, unless and until because we are not intention to sell or settle it down, so the balance is carried forward to the other accumulated other comprehensive income. In cash flow hedge, it is basically we are going to be settled down on a periodic basis. So that's why the like whatever the amount available in OCI that we need to shift to the current income expenses account. Anyone has any doubt here? Are you able to understand this 6 things? No hedge designation, fair value hedge, cash flow hedge. If we are doing a hedging or the transaction we just intend to earn the income, then it is a speculation. Okay, and if it is a speculation, then you need to consider this as a current year profit and loss. Okay, you do not have any underlying transaction where you can knock off. Okay, then fair value hedge, when there is a underlying transaction, I mean the primary transaction, then first you need to adjust the gain and loss in the primary transaction. And the cash flow hedge we need to rotate through other comprehensive income. But when we conclude the cash flow, okay, when we dispose of the entire liability, then we need to transfer from other comprehensive income to the income statement. Okay, And the foreign currency hedge, the same thing. The fair value is basically routed through the current earning. Cash flow, first we need to route it through other comprehensive income. One, we settle the liability or settle the amount, then we need to transfer to the income expenses statement. Net investment, generally it is when we are translation or the remeasurement doing, okay. And as the subsidiary we are not going to liquidate, so that's why we are not able to settle it down. So that's why it is carry forward through other accumulated comprehensive income, accumulated other comprehensive income. Anyone has any
So the
doubt?
foreign currency hedge will be asked in TBS, task simulations.
Yeah, they may ask in a task-based simulation. But it is just like an MCQ type. It is not, you need to do the detailed calculation, but 3-4 line item they may ask in a TBS.
Okay.
Then reporting of the cash flows. So no hedging designation means speculation. So cash flow from derivative with no hedging designation should be accounted for in a investing activity unless the derivative is held for trading purpose. If held for trading purpose, then the cash flow should be accounted for in a operating activity. Okay. So means if you're doing regular speculation, then it is an operating activity. But if you're doing occasionally, then you need to consider this as an investing activity. And hedging designation. So cash flow from derivative with a hedging designation may be accounted for in the same category as item being hedged. Means the with a primary contract. Okay. So if the derivative contains an other non-insignificant category, okay, um, in cash flow, then that derivative should be reported as cash flow from financing activity, not just those related to the financing element. Okay. Yeah. Anyone has any doubt here? Then lease. Okay. So in lease, first is basically the lessee and then lessor. Okay. Then the lease are basically finance lease and operation lease. Finance lease is basically means in like I'm just giving a rough idea, then we will do in a detail. When you are using entire life of asset on lease, okay, so then you need to consider is a finance lease. It is just like that. Asset is purchased by the person who gave a rent, who give you on a rent exclusively for you. So it is as good as your asset. Okay. And whatever may be the amount he paid as for acquiring the asset, that we need to consider as a financing from his side. Just a minute. Okay. Entire life of the asset or whatever may be the lease payment over lease term. Okay. That also we need to consider as a payment over lease term. That is also we need to consider this as a no lease payment over lease term after discounting cover the value of asset. Then also we need to consider as a finance lease. Like say for I purchased the property like the equipment for 5 lakh and I'm giving for on a lease to someone for 10 years. Whatever the lease rental he is paying, if I discount with a 10% discount rate, still the present value of all lease payment, okay, is greater than value of the asset or cost of asset. that means entire payment is done by the lessee. Okay, so that means he is giving all the amount for that asset or the equipment in EMI. So that's why we need to consider this as a finance lease. Operating lease, I mean, if we are not utilizing the full value of the asset or whatever the payment we are doing, okay, so that is not cover the entire asset value. Okay, means there is a certain percentage which we'll see later on, then we need to consider as an operating lease. Or if it is not finance lease, then it is operating. Then it is operating lease. Clear? So we see that some criteria. Okay. So ownership of the underlying asset transfer from lessor to lessee by the end of the lease term. Okay. So these are some other criteria. Okay. First we saw if I'm utilize the full value, full life of the asset, so it is a finance lease. Whatever the rent I'm paying or the lease I'm paying over the lease term, if I discount it with the proper discounting factor and the present value of the all lease payment is greater than the value of the asset, then it is a finance lease. Beside this, ownership of the underlying asset transfer from the lessor to lessee by the end of the lease term. Means after completion of the lease term, automatically ownership get transferred from lessor to lessee. Okay, lessor to lessee. Okay, so that means again, I mean, the way we are buying an house and mortgage with the bank, once we complete all the EMIs, house is automatically transferred in our name. Okay, so the same way, if the ownership at the end of the lease term get transferred in the name of lessee, then we need to consider this as a finance lease. The lessee has the written option to purchase the underlying asset. The option is one that the lessee is reasonably certain to exercise. Means there is an option that the asset will be purchased by the lessee and he is prepared to buy it. In that situation also we need to consider this as a finance lease. Then the net present value of the lease payment and any guaranteed residual value equals or exceeds substantially all of the underlying asset value. Okay, guaranteed residual value means the scrap value. Say for equipment is brought, the cost is basically the 5 lakh and 10,000 is the scrap value. So all like the discounted value of the lease payment is 4 lakh 90,000. Okay, so plus 10,000, which is equal to 5 lakh. Okay, so that's why it is considered as a finance lease. Then the term of the lease represent the major part of the economic life remaining for the underlying asset. So just we discuss, if the major part of the asset life is used by the lessee, then it is also considered as a finance lease. Then asset is specialized such that it will not have an expected alternative use to the lessor when the lease term end. Means particular asset used for a particular operation and which is on that operation is carried out only by the lessee. So in that situation also we need to consider this as a finance lease. Okay, so for the lessor, if none of the criteria above are met, the classification will depend on whether both of the following criteria are met. Means if it is not finance lease, then we need to see this two element. Okay, so present value of the sum of lease payment, lease guaranteed residual value not included in the lease payment, and any third party guaranteed residual value is equal to or substantially exceed the underlying value of the fair asset value. Means what happened if the government gave a grant? I mean, just understand, like say for value of the asset is 5 lakh. Okay, the fair value of the lease payment, okay, fair value of the lease payment 5 lakh. So fair value of the lease payment say for 3 lakh. Okay, 10,000 is a residual value and the government is giving a grant of 1 lakh 90,000. So all together this will become a 5 lakh. So in that situation also we need to consider this as a finance lease. Then collection of the lease payment and any such amount restrictionary to satisfy the residual value guaranteed is probable. means whatever may be the amount 1,90,000 that we can collect. Okay, so if these two conditions are, when both of the criteria above are met, the lessor will classify the lease as a direct financing lease. If only one or the neither are is only one or the neither are met, the lessor will classify the lease as an operating lease. Means first this 190,000 should cover, okay, and the second we can collect it. Then and only then we need to consider as a finance lease. Okay, if we cannot collect it, okay, so in that situation we should consider this as a operating lease. Clear? So assuming that the lease is greater than 12 months in a duration, the determination of how the lessor account for a lease on the base of owner owns PC criteria. So sales type lease, at least one of the owns criteria is met, and direct financing lease, none of the owns criteria are met, but both the PC criteria are met. Okay, owns and PC is basically, this is PC, and owns is basically this one: ownership, return, net present value, economic life, and specialized. Okay, so first thing, to be qualified as a finance lease, it should be for a more than 12-month period. Okay, and determination of the lessor account for the lease is based on the owns PC, means all the owns criteria plus this two. Okay, then sales type lease, at least one of the owns criteria are met, means whether it is a sales type or the direct financing, that we will discuss in detail. Okay, so cell type leads at least one of the own criteria are met. Direct finance leads, none of the own criteria are met, but both of the PC criteria are met. Means the sales type lease is basically, it is as good as the sell to the lessee if this criteria are met, and if it is a finance, then this criteria are not met, but this two criteria are met, PC. Okay, so then it is a finance lease. And the operating lease, if it is not the finance lease, then we need to consider this as a operating lease. Means none of the own criteria are met, and either one or no PC criteria are met, then we need to consider this as a operating lease. Okay, clear? See, first six, like how many? 1, 2, 3, 4, 5, or the 5. Okay, 1, 2, 3, 4, 5. Yeah, if the first 5 criterias are met, okay, so then we need to consider this as a sales type lease. Okay, if this criteria are not met, but this two criteria are met, even though we need to consider this as a financing lease. Okay, if all the 5 criteria are not met and one of this criteria are not met, then we need to consider this as a operating lease. Okay, so sales type, direct financing, and the operating lease that you need to consider. Discount rate, when calculate the present value of the minimum lease payment, the lessor will use the rate implicit the lease. Okay, so discount rate is basically the expected earning rate on the investment. Like if someone invested 1 million, he may expect minimum 10% interest rate. Okay, so whatever may be the EMI we are paying, that we need to discount with the 10%, and then he need to evaluate whether it is equal or more than 1 million. So it is the implicit rate for the earning expectations. Okay, now we need to see the lessor accounting, lessor in the books of lessor. Okay, if it is a sales type lease, okay, so see what happened. There is a particular fix when you I mean we are thinking about the lessor point of view. He purchased the asset for lease. Okay, now at the time of purchase, it is basically the fixed asset debit to cash account credit or the account payable, whatsoever may be. Clear? First point. Second point, when it is a finance lease, okay, that means asset is used by the lessee. Okay, so he need to capitalize the asset. Okay, so what happened? He will the lessor will recognize the entry lease receivable debit to asset account credit, because entire life of the asset used by the lessee. So it is not the asset of the buyer. It is basically the asset of the lessee. Okay, so here lease receivable fixed asset. Okay, if there is a difference in this value, then it is gain and loss. Whatever may be the debit credit. Clear?
Hello?
Huh. Yes.
If the asset is kept for less than period of 12 months, then what are the criterias which should be met?
No, no. See, if it is less than 12 months, okay, so that means it is an operating lease, na? Because and even if it is the like the asset, see, if particular equipment have a value life less than 12 months, okay, so it is an operating expenses. It is not qualify for the asset.
Okay.
Okay, so first thing. Second, still if you are giving something on a rent for a 5 month, okay, so by default you do not require to test anything. It is an operating expenses. You can
Okay.
test for a finance lease when it is more than 12 months.
Okay,
Okay,
sir.
yeah. So lease receivable, okay, this is basically the discounting. It is not the like 10,000 I am paying per month for 3 years, so it is 3,60,000. That is not the case. It is basically the discounting. Okay, so it is the discounting. Okay, when you are getting an EMI lease, okay, so this may be, you consider the first is fixed asset debit, cash account credit, then lease receivable debit, it is discounting factor, asset account credit, and then whatever may be the difference, that goes to the gain and loss. When you receive the lease payment, okay, so what you need to do, lease receivable account credit, okay, with a principal amount, okay, interest account credit, okay, and the cash account debit. So cash, lease payment debit, interest income, and the lease receivable. I hope you are able to understand why I am recognizing interest income, because here I consider the discounting value, okay, and with a 10%, so per year I am getting a 10% income on my remaining balance of the lease receivable. Okay, say for like if I consider the 1 million or 100,000, okay, the discounted value is 80,000, say for, okay, and I consider the 10% as an interest rate, okay, so lease receivable is 80,000. 20,000 is basically my implicit interest over the period of the lease term, okay, so this is basically the lease receivable. Okay, I am getting a rent of 10,000, which include 2,000 as an interest. Okay, means for 10 years, say for 20,000, like this, per year it is 2,000. Okay, and 10,000 means 8,000 for a 10 month. Okay, so what I am going to do, I am reducing the 80,000 lease receivable, and now it is a 72,000. Okay, means I am reducing by 8,000, and the remaining 2,000 I am showing as an interest income. Clear? Any doubt here? Why we need to recognize the interest income? Because whatever the EMI I am getting, that is already I discounted as in a lease receivable. So I am getting an excess EMI. So that excess portion is representing my interest income. Clear? Then reporting a sales type lease in a lessor books. So Jenkins Inc. leases a truck to bring company for 4 years at 5,000 per year, with the payment due at the end of the year. with the initial direct cost of $450 and implicit rate of 6% on the date of lease commences 1st January year 2. So the carrying value of the fair value of the truck is 22,000 and 24,216. Carrying value is 22,000 and the fair value is 24,216. Okay, so whenever we transfer the asset, first we need to convert to the fair value. That also you need to keep in mind. The lease contract requires the lease to guarantee the residual value at the end of the 8,700. Okay, so residual value is 8,700. If the lease treated as a cell type lease and assuming that the collection of all amount owned is probable, determine the lessor journal entry. See, we will see. So lease expenses 450, it is the start expenses, and the lease receivable is 24,216. Okay. So like the fair value of all the lease is 24,216. So that's why I consider this. And the cash is 450 when this is an expenses. So whatever may be the carrying value of the asset, okay, that we need to reduce from the asset side, and whatever may be the difference that we need to recognize as a gain. So lease receivable, this is the present value of all for payment of the 5,000 at a 6%, which is 17,325 plus whatever may be the residual value at 6% at the year end. Okay, so this basically how to do it. Like 5,000 5,000, 5,000, 5,000, 5,000, and the fourth year we will get the 8,700. Yeah. If I consider the discounted rate with a 6%, so 1 divided by 1.06. So it is 0.94. Then divide by 1.06, 0.89, divide by 1.06, 0.83, divide by 1.06, 0.79, and the same applied to here 0.79. Okay, so it is 0.89, 0.83 plus 0.79, which is 2.485, means if I add this 4 multiplied by 5,000, three point four five 5,000. So it is 3952 at 6%. What should be 70.79. Yeah, it is 17,250 approximately. So it is 325. So there is a difference. And if I multiply this, then it will come around 689. Okay. So these are my present value of the lease rental like this. Okay. Plus residual value. Okay. So the gain 2216 is difference between the lease receivable minus the value of the asset. Okay. Second, first payment when we receive. So cash we got the 5,000. So interest income 1453 and 3547. So 6% if I consider, okay. So 6% of 17,250 in a first year. So you will get something 1453, and the remaining amount is less receivable. So this is basically the amortization table. Okay, so that way we need to solve. So here if you see, this is basically the amount. I mean, when we start with the 24,216, the 5,000 is my lease payment, the interest receivable is 1453, and the lease receivable change is 3457. Tomorrow I will prepare this table in an Excel. I will show you. Okay, so you can understand. Here, just you need to keep in mind, the first is basically like how we are going to recognize the cost and the lease receivable and the de-recognition of the asset. Okay, and the second, when we got the first payment from the lease, then how we are going to reduce the my lease receivable and recognize the interest income. Okay, tomorrow I will start with this example only, and I will show you means how to prepare this amortization table, because that is required for the lease accounting. Okay, anyone has any doubt till now?
Tomorrow you will start with the example from the starting, right?
Yeah,
Because there
yeah.
is little
The
confusion.
same example, same example.
Okay.
Okay. So anyone has any point? Anyone has, want to discuss something? Okay. So if no point, then I'll close the class for today and tomorrow morning 8 o'clock. Okay.
Thank you, sir.
Thank you. Bye everyone.